Understanding distressed securities. How vultures spot broken assets. Welcome back to The Art of Vulture Investing. In Episode 2, we talked about the mindset of a vulture investor, how they stay calm, think long-term, and see opportunity in risky places. Now in Episode 3, we'll explain the tools they use, something called distressed securities. So what are these? Let's break it down in simple terms. What are distressed securities? A security is a financial product, like a stock or a bond, that you can buy or sell. A distressed security is a stock or bond from a company that's in serious trouble. It could be losing money, owing too much debt, being sued, or going through bankruptcy. These securities drop in price because everyone thinks the company might fail. That's when vulture investors get interested. Why do they get so cheap? Let's say a company owes a lot of money and can't pay it back. It announces bankruptcy. Most people panic and sell the company's bonds or stocks at very low prices. Now, a bond that used to be worth $1,000 might be selling for just $200. Why? Because investors think they might not get their money back. But a vulture investor might look deeper and say, wait, even though the company is in trouble, its assets, like buildings, land, or patents, are still worth a lot. If I buy this bond for $200, I might get back $500 or more when the company sells its assets. That's the core idea, buying low when others are scared. The three main types of distressed securities. Let's look at the three main types that vulture investors watch. 1. Distressed bonds. These are loans given to a company. When the company is in distress, the bonds trade for much less than face value. Example, a company promises to pay $1,000 in 5 years, but now, due to financial trouble, its bonds are selling for $300. If the company recovers or sells assets, that bond might pay out more than $300, and that's a win for the investor. 2. Distressed bank loans. Sometimes banks lend money to companies. If the company fails to pay, the bank may sell the loan to another investor at a discount. Vulture investors can buy that loan cheaply and try to recover more money later. 3. Distressed equity, stock. If a company is close to bankruptcy, its stock price may fall heavily, sometimes to just a few rupees. But if the company survives, restructures, or gets bought out, that stock can rise again. Buying at the bottom could give huge returns, but this is the riskiest form. Real world. Example. Imagine a company called Alpha Motors. It has factories, land, and brand value, but it also has too much debt. It enters bankruptcy. Its U-1000 bond is now trading at $200. A vulture investor buys the bond. A few months later, the court approves a plan to sell Alpha Motors assets. Bondholders get $500 back. So the investor makes $300 profit, a 150% return. This is how vulture investors make money from distressed securities. Why most people avoid them? They are hard to understand. They involve legal paperwork. There is real risk of losing money. You might need to go through bankruptcy court to get paid. But vulture investors know that this is where the biggest rewards hide. What makes these deals work? To succeed, the investor needs to ask, how bad is the company's situation? What assets does the company own? What will happen in bankruptcy court? How much can I recover? And how long will it take? Is the discount price worth the risk? If the answers look good, the investor might buy the distressed security and wait for recovery. What George Schultze says. In his book, Schultze explains that not all distressed securities are good deals. Some are value traps. They look cheap, but they never recover. That's why he studies every detail, court filings, debt documents, asset values, and business plans. He once invested in a bankrupt energy company because its land and mineral rights were still very valuable. Other investors ignored it, but he made a strong return. What returns can they get? Returns can be huge, sometimes 50%, 100%, or more. But it takes time, deep research, a strong stomach. Because when you invest in distressed assets, there's always a chance the company never recovers. That's the risk. Bankruptcy court and debt priority. In bankruptcy, not everyone gets paid equally. Secured lenders, banks with collateral, get paid first. Bondholders come next. Stockholders are usually last. That's why vulture investors prefer bonds and loans. They are higher in the payment line. Stocks can give big rewards, but also come with the highest risk. Example of a recovery process. The company files for bankruptcy. The court appoints a process to manage the company's debts. The company sells its assets. The money goes to creditors in a fixed order. The vulture investor who bought bonds owed $200 might now get $500 back. This can take 6 months to 3 years, depending on the case. What you learned today. Distressed securities are bonds, loans, or stocks from troubled companies. Vulture investors buy them cheap and try to make a profit after bankruptcy or recovery. The process is risky, slow, and complex, but also very rewarding if done right. What's next? In Episode 4, we'll learn how vulture investors find these opportunities, what they look for, where they search, and how they decide whether a company is worth investing in. Thanks for watching Episode 3. Please like, subscribe, and comment if you're learning something new from this series.